There is an invisible script that has been passed down from one generation to the next. It isn't written in textbooks, it isn't formally taught in schools. Yet almost all of us grow up living by it. Our parents repeat it, our grandparents reinforce it, and the real estate industry echoes it endlessly, with perfect smiles on billboards, at open houses, and through well-meaning advice. That script says renting is throwing money away. You're paying someone else instead of building your own wealth. Buying a home is the moment you become a real adult. Buying a home is the best investment you will ever make. We don't just hear these ideas, we internalize them. Over time, they become part of our identity. So much so that if you're still renting at 30, you don't just feel behind. You feel wrong. Wrong path, wrong timing, wrong financially, and almost wrong morally. There is a very specific kind of shame that comes with telling people you're still renting, as if you haven't properly launched into adulthood, as if you're delaying an obvious responsibility that everyone else has already accepted. And it's this feeling, not math, not data, that pushes millions of people into rushed financial decisions. We panic. We buy homes not because the numbers make sense, but because social pressure tells us we must. We stretch our debt-to-income ratios to the breaking point, convincing ourselves that signing a deed automatically makes the decision smart. But there is an uncomfortable truth few people want to say out loud. In the modern economy, for millions of people, this script is no longer true. The math has changed, the market has changed, but blind faith in homeownership remains untouched. And that faith is trapping an entire generation in a very specific kind of prison, a prison of illiquidity, inflexibility, and stagnant growth. To understand why buying isn't always better, we first have to redefine what throwing money away actually means. When you rent, the transaction is simple. You pay a monthly fee in exchange for a roof over your head. That money is gone. No equity, no ownership, no illusion. And because it's so obvious, renting is easy to criticize. But when you buy a home, something very different happens. You are told that your monthly payment is not an expense, it's saving. You are told you're paying yourself. You are told that every check you write is quietly turning into wealth. This sounds reassuring. It feels responsible. But in the early years of homeownership, it is largely false. A significant portion of your monthly housing costs as an owner is also money that disappears forever. It doesn't come back to you. It builds zero equity. It does not increase your net worth. These are what we call unrecoverable costs, and they are the silent killers of long-term wealth. The first and largest is the cost of capital, primarily mortgage interest. In the early years of a standard 30-year mortgage, roughly 70 to 80% of your monthly payment goes straight to the bank as interest. You are not paying yourself. You are renting money from the bank. You might send $3,000 every month, only to discover that $400 of it actually reduces your debt. The rest simply vanishes. It is mathematically identical to rent, just far less obvious. Second, there are property taxes. This is a permanent payment to the government for the privilege of staying on land you supposedly own. In high tax areas, this cost alone can rival a modest rent payment. Third, there is maintenance. The common rule of thumb is 1% to 2% of the home's value every single year. This isn't luxury renovations or aesthetic upgrades. It's the unglamorous reality. Water heaters failing, roofs aging, plumbing issues, pest control, electrical repairs. Fourth, there is homeowner's insurance, a cost that continues whether the house appreciates or not. And finally, there are transaction costs. Buying and selling a home can consume up to 10% of the property's value. Years of accumulated equity can evaporate the moment you exit. When you add these together, interest, taxes, maintenance, insurance, and fees, you often find that the unrecoverable cost of owning a home is nearly identical to, or even higher than, the cost of renting a comparable property. You are not escaping rent, you are simply paying a different landlord. One landlord is visible and honest, the others are the bank, the government, and the hardware store. At the end of the day, the rent versus buy decision usually comes down to a single number. One metric that quietly reveals whether a housing market is priced for ownership or speculation. This number is called the price-to-rent ratio. Think of it as the housing market's version of a price-to-earnings ratio in stocks. It tells you how expensive ownership is relative to simply renting the same living experience. The calculation is simple. You take the price of a home and divide it by the annual cost to rent a similar property. If a home costs $500,000 and rents for $2,000 a month, that's $24,000 a year. 500,000 divided by 24,000 gives you a ratio just over 20. Historically, a ratio below 15 suggests buying may make sense. A ratio above 20 strongly suggests renting is the mathematically safer choice. This is not opinion, it is arithmetic. And here's where the modern problem appears. In many major cities today, global financial hubs and cultural centers, the price to rent ratio isn't hovering around 20. It's pushing 25, 30, sometimes even higher. At those levels, the math doesn't whisper, it screams. When the ratio gets that extreme, the cost of capital on the purchase price vastly exceeds the cost of rent. You are paying an enormous premium for ownership, not shelter. In these markets, renting creates a strange but powerful position. You are effectively living inside a high-value asset for a fraction of what it would cost to finance it. You are consuming housing services at a discount. The landlord takes on the risk. They absorb the shock if the boiler fails, the foundation cracks, or the market turns downward. They are betting on appreciation that may or may not materialize. Meanwhile, you maintain flexibility, liquidity, and control. In a high-ratio environment, renting is not a sign of weakness. It is a form of arbitrage. You are letting someone else tie up massive capital, accept long-term risk, and shoulder unpredictable expenses, while you preserve your ability to allocate money elsewhere. This flips the traditional narrative on its head. Instead of believing you are subsidizing the landlord, you begin to realize the landlord may be subsidizing you. The most dangerous trap in homeownership isn't the mortgage. It isn't maintenance. It isn't even market risk. It's something far quieter, something rarely discussed at dinner parties. The opportunity cost of the down payment. To buy a $500,000 home, you are typically required to put down around $100,000, 20%. That money doesn't disappear. But it does something just as damaging. It becomes locked. Once the check is written, that capital is sealed inside the walls of a single property. It produces no cash flow. It cannot be easily accessed. It cannot be rebalanced. It cannot be deployed elsewhere without friction, fees, or debt. This is what we call debt equity. That $100,000 cannot help you pay for groceries. It cannot cover an emergency without refinancing. It cannot be shifted when better opportunities appear. It just sits there, waiting for appreciation. And by doing so, it creates a massive, often invisible bet. By locking that money into one house, you are betting that a single local real estate market, one city, one neighborhood, one block, will outperform diversified global capital markets over decades. Historically, this is a losing bet. If that same $100,000 were invested instead, not speculatively, but broadly and patiently, its expected return would compound over time. At roughly 10% annual growth, money doubles approximately every 7 years. That is not optimism, that is math. By choosing to place that capital into a primary residence, you are trading liquidity and compounding for concentration and hope. You are also accepting a deeper psychological cost. Once your wealth is trapped inside a house, your options narrow. Your tolerance for risk declines. Your ability to adapt weakens. You become asset-rich on paper and cash-poor in practice. This is why many homeowners feel paradoxically stressed despite owning an expensive asset. Their net worth exists, but it cannot move. By contrast, a renter who invests both the down payment and the monthly savings created by renting maintains flexibility. They remain liquid, they remain diversified, they retain control. This is the foundation of the rent and invest the difference strategy. And for disciplined people, it is not conservative. It is quietly aggressive. It converts a static lifestyle purchase into a dynamic wealth engine. It replaces pride of ownership with financial optionality. We rarely talk about liquidity and mobility as assets. They don't show up on net worth statements. They don't feel tangible. But in the modern economy, they may be among the most valuable assets you can hold. A house changes your relationship with movement. Once you buy, you are no longer simply choosing where to live. You are making a long-term bet that your current location will remain optimal for your career, your lifestyle, and your income for many years into the future. That is a bold assumption. The economy shifts quickly. Industries rise and fall. Opportunities appear in unexpected places and disappear just as fast. For a renter, responding to change is relatively simple. If a better job appears in another city, one that pays significantly more or offers a better quality of life, the renter can act. 30 days, minimal friction, low cost. For a homeowner, the story is very different. Movement becomes expensive, slow, risky. Selling a home is not a decision, it is a process. Agent commissions, closing costs, repairs, staging, time on the market. And if the market happens to be down when you need to move, the penalty can be severe. Years of accumulated equity can be erased in a single transaction. In that moment, the house stops feeling like an asset. It feels like an anchor. By buying, you are effectively shorting your own flexibility. You are betting that life will cooperate with your timeline. Sometimes it does, often it doesn't. Liquidity, on the other hand, preserves optionality. It gives you the ability to say yes when opportunity appears, and no when conditions worsen. This is especially important in a world where careers are no longer linear, where remote work, contract roles, and geographic arbitrage are becoming normal, where the ability to move can directly translate into higher income and lower costs. Renting keeps that door open. It allows you to treat location as a variable, not a commitment. It lets you optimize as circumstances change instead of locking yourself into a single outcome. None of this means homeownership is a mistake, but it does mean it carries a cost that rarely appears in spreadsheets. The cost of reduced mobility, the cost of delayed decisions, the cost of missed opportunities. In a volatile world, flexibility has a premium value, and renting is one of the few ways to buy it. At this point, the strongest objection always appears. Rent goes up, my mortgage is fixed, and this argument deserves to be taken seriously, because it is partially true. A fixed-rate mortgage does provide a form of protection against inflation. Once the loan is locked in, the principal and interest payment remains the same over time. As wages rise with inflation, that payment can feel smaller in real terms. This is the most compelling case for buying. But it is also incomplete, because while the mortgage payment may be fixed, homeownership costs are not. Property taxes rise steadily as cities reassess values and search for revenue. Insurance premiums increase, especially as climate-related risks grow more frequent and severe. The cost of labor and materials to repair and maintain a home rises with inflation as well. Roof replacements do not get cheaper. Plumbers do not charge less over time. Appliances do not fail politely during convenient financial moments. Inflation does not disappear when you own a home. It simply finds different ways to reach you. Rent, on the other hand, does increase. That is undeniable. But what is often ignored is the other side of the equation. If you are renting and investing the difference, your assets are also growing. Equities, over long periods of time, tend to compound at rates that exceed inflation. If your investment portfolio grows at 7 to 10% annually, while rent increases at 3%, the gap works in your favor. You are using appreciating assets to pay for a rising cost of living, rather than relying on a single illiquid asset to justify itself. In this model, your wealth grows independently of where you live. Your financial future is not tied to the condition of one roof or the trajectory of one neighborhood. The homeowner's protection against inflation is concentrated. The renter-investor's protection is diversified. Neither approach is risk-free, but one depends heavily on a single asset behaving perfectly over decades. The other spreads risk across many income-producing assets. When viewed this way, the argument shifts. The question is no longer whether rent goes up. The question is whether your assets grow faster than your rent. And for disciplined investors, they often do. There is a cost of homeownership that rarely appears in spreadsheets. It has no line item, no monthly statement, no neat percentage attached to it. It is the cost of time and mental energy. Owning a home is not a passive experience. It is not something you buy once and forget about. It is a responsibility that quietly demands attention, week after week, year after year. Something is always aging. Something is always wearing down. Something is always waiting to break. A strange sound in the basement, a leak that starts as a drip and becomes a repair, an appliance that fails without warning. When you own, there is no number to call that makes the problem disappear. You are the number. Weekends that could have been spent resting, learning, or building something new are often redirected toward maintenance. Trips to hardware stores, researching contractors, waiting for quotes, scheduling repairs. None of this is catastrophic on its own, but over time, it adds up. Homeownership becomes a part-time job, one that pays no salary, offers no promotion, and provides no clear return on effort. Renting shifts that burden elsewhere. When something breaks, you make a call. The responsibility ends there. This outsourcing of stress is often dismissed as laziness, but in reality, it is a trade. You are trading pride of ownership for reclaimed time. and time has value. Time can be invested into skills that increase income. Time can be used to build side projects, businesses, or networks. Time can be spent resting, which improves long-term productivity and decision-making. Mental bandwidth matters. When your attention is not constantly pulled toward maintaining a physical asset, it can be directed toward building financial assets. This is why many renters quietly outperform homeowners, not because they are smarter, but because they are less distracted. Many people buy homes seeking stability, only to discover that ownership introduces a low-level, persistent anxiety. The fear of the unexpected expense, the pressure of upkeep, the constant awareness that deterioration is inevitable. Renting does not eliminate responsibility, but it concentrates it where it belongs, on the owner. And in doing so, it frees the renter to focus on growth rather than maintenance. None of this means that buying a home is always a mistake. That conclusion would be just as simplistic as the script we are dismantling. Buying can make sense in specific situations, under specific conditions. If you are planning to stay in one place for a long time, typically 10 years or more, the transaction costs have time to amortize. If you deeply value the ability to customize, renovate, and emotionally anchor yourself to a space, ownership may provide satisfaction that numbers alone cannot measure. And if the price-to-rent ratio in your area genuinely favors buying, where ownership costs are meaningfully lower than renting, then the math may support it. But those are conditions, not defaults. The mistake is treating homeownership as a mandatory step toward wealth. The mistake is buying out of fear of falling behind, fear of judgment, fear of throwing money away on rent, while ignoring the money quietly thrown away on interest, taxes, and inflexibility. A primary residence is, at its core, a consumption choice. It is no different in principle from choosing a nicer car or a more expensive lifestyle. It may bring comfort, it may bring pride, but it does not automatically bring wealth. The danger appears when people confuse comfort with investment. When a house becomes your primary investment, your financial life becomes dangerously concentrated. Your net worth is tied to a single physical asset in a single location, exposed to local economic conditions, environmental risk, and policy changes you cannot control. One natural disaster, one zoning change, one neighborhood decline. That is all it takes to disrupt the illusion of safety. Wealth is not built by owning deeds. It is built by owning income-producing assets, assets that pay you, assets that grow independently of where you sleep at night. Stocks, bonds, businesses. These assets do not demand maintenance calls at midnight. They do not leak. They do not crack. They compound quietly while you live your life. A house, by contrast, is an asset that you pay. That does not make it bad. It simply makes it different. The goal is not to reject ownership. The goal is to reject blind obedience to a cultural script. Run the numbers, check the ratio, account for unrecoverable costs, respect opportunity cost, and if the math says rent, then rent without shame. Rent with intention, invest the difference, build liquidity, preserve flexibility, let the landlord worry about the roof. At its core, this conversation was never really about rent versus buy. It was about freedom. It was about refusing to let a cultural script make decisions on your behalf, especially decisions that shape decades of your life. The idea that owning a home is the automatic path to wealth is deeply ingrained. It is repeated so often that questioning it feels rebellious, even irresponsible. But wealth has never been about symbolism. It has always been about cash flow, flexibility, and ownership of productive assets. A deed does not generate income. A mortgage does not create freedom. An equity you cannot access does not protect you when life changes. What protects you is optionality, the ability to move, the ability to invest, the ability to say no, the ability to adapt when the world shifts beneath your feet. For some people, buying a home aligns with those goals. For many others, it quietly works against them. The mistake is not choosing ownership. The mistake is choosing it without understanding the trade-offs. A primary residence is not a moral achievement. It is not a rite of passage. It is not proof of intelligence or success. It is a lifestyle choice. And like all lifestyle choices, it has a cost. If you treat your home as your primary investment, you are building a portfolio that is concentrated, illiquid, and fragile. One that depends heavily on forces you cannot control. Real wealth is quieter. It comes from assets that work while you sleep. Assets that pay you rather than demand payment. Assets that grow regardless of where you live or what your roof looks like. Stocks, businesses, productive capital. These are not glamorous. They do not photograph well, but they compound. So do not let fear push you into decisions that math would never recommend. Do not buy because you feel late. Do not buy because you feel judged. Do not buy because someone told you rent is throwing money away, while ignoring the interest, taxes, and opportunity cost quietly draining your future. Run the numbers, be honest with yourself. And if the math says rent, then rent with confidence. Invest the difference, build liquidity, protect your flexibility, and let the script end with you. If this breakdown helped you see the decision more clearly, take a moment to support the work. Like the video, subscribe for more analysis that challenges financial myths, and share this with someone who feels pressured to buy before they're ready. I'll see you in the next one.